Streamline Refinance is presented by Mountain West Financial. Thank you for joining. We've got a lot of changes to discuss this morning, so we're going to move forward. I've got Shelley Collins, Vice President of Underwriting and Credit Risk, and Gary Martell are our speakers today, and we're glad you could attend. So what is the purpose of a Streamline FHA loan? A Streamline Refinance is designed to help lower the monthly principal, interest, and MIP payments on a current FHA insured mortgage. And one of the unique things is it can be made without an appraisal.
And this gets important because as we have a little history lesson, those of you that have been in the business a long time, Streamline has undergone several reconstructions over the years. Years ago, we used to be able to do them with an appraisal, without an appraisal, used to add on a lot of closing costs, and it made it a different loan amount altogether. 2011, HUD put out a very important bulletin, Mortgagee Letter 2011-11, which created some very significant changes. Going forward from then, Streamline refinances have really only been done without an appraisal.
So there are some great benefits to doing a Streamline Refinance FHA loan. We've already discussed the fact that you can decrease the borrower's monthly mortgage payment. And there's reduced documentation requirements that result in faster processing, expedited underwriting. There's no DU required. Can be used by both investors and non-occupant borrowers. There's no 4506T required. And there's no verbal VOE on non-credit qualifying.
You know, the real benefit, obviously, is that we're able to improve the borrower's home loan from what it is, or at least an existing FHA borrower. Question comes sometimes, you know, can a non-FHA loan be an FHA Streamline? And, of course, Shelley will nod her head that you can't. But we want to make sure that when we look at the benefits of an FHA Streamline, that it has to be the right option for the homeowner, right? As you know today, mortgage insurance premium, what's put on there is life of the loan insurance. And depending on what your final CLTV, your final LTV is, you have a monthly amount that varies by 0.5%. We're going to show some examples of this as we go along. So sometimes it's worth it for the borrower to maybe bring in a couple dollars to lower that MIP, the monthly amount, so that at the end of the day they have a much better long-term mortgage. And as we've seen a lot of times discussing the options with the borrower, Streamline Refinance is not always the best option. Many times it's well worth it to the borrower to pay for an appraisal and go through the credit processing to get a mortgage with today's appreciation that possibly has mortgage insurance that can be dropped off in a couple years, and or in some cases with advent of increased appreciation, we've seen them go to conventional loans where they can eliminate mortgage insurance. And then, of course, there's the other side of the coin. Maybe it's not the time for them to refinance. Maybe they need to wait 6 or 12 more months, a little more appreciation, so that, you know, again, they end up with a much long, you know, if they're going to stay in the house, you want the long-term benefits for it. And there's borrowers that are leaving their home in 6, 12 months, and in that case, refinancing would not be a good option. So again, there's a great benefit to the Streamline Refinance, but as we know as good loan officers, we need to guide the borrowers to make sure that this truly is the best program for them.
So as Gary alluded to, we also have the ability to do credit qualifying streamlines. The credit qualifying streamline is required when you have an FHA loan when you're removing someone from title. Those borrowers qualified for the initial loan amount, and therefore if you take someone off, we're taking income away. So we're taking away potentially the capacity for that new borrower, only borrower, to be able to qualify. So the credit qualifying provides us, as a lender, a level of insurance for continued performance on the mortgage by validating that the remaining borrowers have an acceptable credit and ability to repay. And as with all Streamlines, which are manual underwrite, no DU, we have to analyze the borrower's income and credit, and the DTI must conform to no more than 31/43 ratios. And the loan amount is calculated much like the non-credit qualifying Streamline.
Yeah, so in that case, many times doing a credit qualifying streamline, it might be a much better idea to be able to do a rate and term refinance and be able to use DU as a tool to help us with the ratios and stuff.
Absolutely. So there are a number of changes that we've made on Streamline Refinances. As you know, last round that we did in 2012, we were only allowing 30 days of interest on the mortgage. So we came to the decision that we can do up to 60 now. So you have the ability to either calculate 30 days or 60 days. Now, please keep in mind that the interest used for the mortgage calculation is going to be based on the borrower's due date and the interest due on the existing loan from the demand. So if you have 60 days of interest on the demand, you're more than welcome to finance up to the 60 days of interest on the demand. But if you only have 30, you're going to be limited to 30. The other big change is that we've confirmed that we're going to allow up to 2 months of mortgage insurance from the demand to be financed into the mortgage. And so that's your annual MIP or your monthly mortgage insurance that you're going to be able to finance into the loan. And then the third big change, and this will help all of us across the board, is you're going to have an abbreviated 1003. So there are certain sections of the application that you are not going to have to complete, which includes no employment, which is Section 4, no income, which is Section 5, so there's no change there. Assets you're only going to put in, and that's Section 6, that unless you need them for closing, you would not have to input that. Or your declarations section, which is Section 8, and there's the letters A through K are not required. Apologize for that change there. A through K are not required. So the very next letter, L, is the question about whether you're going to live in the property or not.
You know, we're going to touch on this several times during this presentation. If the borrower is not currently residing in the property or has not resided there in the last 12 months, that changes the loan that's available to them. And you just need to make sure as an originator you ask that question, have you lived in the property the last 12 months? And what I like now is you do not have to fill out the rest of the 1003. And we do not have to verify the income, employment. You do have to verify assets. And Shelley, we're probably going to go through that a little bit.
Yes, a little bit.
Okay.
Not a lot,
right.
But a little bit. So what are some other changes? On a Mountain West to Mountain West, we do not require a credit report at all. Only a mortgage rating on the subject property that has no 30-day or more lates in the last 12 months. So you're probably wondering, about requiring a credit score. We do need a credit score to issue out your disclosures. And if you have a Mountain West to Mountain West, you have the ability to use the previous credit score from the old loan.
So we've had a lot of questions. If we have a credit score from the old loan or the existing loan for the borrower, can we use that credit score for our calculations? And the answer is yes. If you run a credit report and you supply us the new credit report with new FICO scores or just the FICO score credits only, we will go with the new ones. Once we have that new credit score, that's the credit score we're going to use. So again, if it's a better credit score, that's great. If the credit score has deteriorated, which sometimes could be the case, and that's the new updated we get, that's what you get to use. So be very cautious with that. Once it gets to underwriting, that's what it stays. Also, I think most of you realize that there is risk-based pricing disclosure that has to be correctly done, whether it's retail or wholesale. We still require those as part of the final closing package, and that's more in the disclosure realm that we're not going to touch on a lot today because the disclosures don't change, because whether it's a regular refinance or a streamline refinance or whatnot, the disclosures are still required, and this is only really regarding the credit and loan calculation.
Right, and that's what we're going to touch on next. So on MWF to MWF, when you have an existing FICO from a previous loan, that can be used to price the loan. The FICO must be input into your point file so that the risk-based pricing disclosure will populate correctly with the credit score. And that's, otherwise, if you don't put that FICO in there, you're going to get a kickback from disclosures that needs to be corrected. So just be aware of that.
And then, of course, if it's non-Mountain West to Mountain West, then we're going to need a minimum of a 12-month mortgage rating or 6-month acceptable on this existing mortgage, and we need FICO scores. We will look at the whole credit if you provide it to us, and we are not going to be analyzing the rest of the credit if it's there.
That's correct. So last week, there's been a lot of changes going, and so it's been an interesting last couple of weeks. We initially had some issues with CalHAPA indicating that on their CHDAPs that they were not going to be willing to subordinate, and now we have that ability that they will subordinate. And on a Streamline Refinance, you can actually go up to 125% CLTV. So with that being said, this is a great change and a welcome change.
And I think that's an important thing to bring forward. If you're an originator and you sit down and you're chatting with the consumer, one of the questions you have to ask at your initial contact point, do you have a down payment assistance second that's attached to this? Because you will need to get that subordination, and in many cases, that may be the thing that takes the longest to get your loan completely processed. And so, you know, with that subordination out there, you need to contact that agency, find out how long they take, what are the steps to do that, because that has to be in place. So we're going to talk about the FHA Streamline check sheet, and whether you're a Mountain West originator or originator working for one of our wholesale partners, we've provided you a very thorough check sheet that's available on either the intranet if you're a staff member here or on our wholesale website.
Correct. And in addition to that, we sent out 2 bulletins last week, 15R-021 and 15W-016. And within these bulletins, there were links to those forms. So, we look for feedback from all of you on any of these forms that we put out. If there's something that works better for you, let us know. We're willing to update things. So, but they're all inclusive and have a lot of good information. The key to using a checklist, obviously, and if we go to the next screen, we'll talk about that. You know, the goal here is these loans are supposed to be easy loans to put together, and our anticipation is that these loans walk in the door, they get underwritten, and they move to docs. We would love to see one touch on this, and there's no reason we can't do that. However, we understand the nature of the beast, and we've put together some minimum requirements for submission on the FHA Streamline, just to give some guidance not only to you, but also to our setup department, because we're not going to have the underwriters underwrite loans that don't have at least the minimum information needed to do the mortgage calculation. It doesn't make sense.
Right.
So we've given you a list of things in here that need to be provided in order for us to accomplish that. So obviously those are the basics: Streamline Refinance max loan amount calculation worksheet, the net tangible benefit. Obviously, the borrower has to have the 5%, the original abbreviated URLA, signed and dated by the borrower and the MLO, MWF to MWF refinances. We need a mortgage rating either from Cenlar or off your credit report or off the mortgage rating with FICOs. Non-MWF to MWF, we need at least a tri-merge with a current mortgage rating or a mortgage rating with credit scores only. Current demand, we need a current demand. And a copy of a statement on the mortgage evidencing either your HOAs, which would be potentially a separate statement, or the statement on the mortgage itself. What we're looking for there, just so you're aware, is not only the principal balance, but also what the monthly MI is. 2 months bank statements, if applicable, if we need those funds. And if we do need those funds, you have to track and source all the large deposits needed for closing and provide a letter of explanation. Prelim or title commitment, with a 24-month chain of title. And obviously your case number assignment from FHA Connection with your borrower is validated. If you cancel the case number, we would also need the case number cancellation, and we actually put processes together on that, so we are getting those directly from the AMC. And then, of course, your FHA Connection refinance authorization. So those are the minimum requirements for submission. If some of those things are in your file, but not all of them, your file is going to stop at setup, and it's going to get pushed back to you.
So here's, again, from an origination standpoint, you know, the important thing is that initial meeting with the homeowner. And you need to make sure that you've asked those questions. You know, since you purchased the home, has there been any changes to the title? You know, do you have any late mortgage payments on this mortgage in the last year or, you know, during the time that you've had this mortgage? And as you guys know, you can't do a streamline unless the mortgage, there's a test for that, has to be over, basically they had to make over 6 payments and a few other minor things. But you also want to ask them for a copy of the payment letter and who's their insurance company and those items, because again, it doesn't help any of us to get that loan submitted unless it has the items on there. And again, if they have secondary financing, make sure you ask that question and see if you can get a hold of whoever that is to start that process. These come in, they should be very simple. You know, we're really working around information on the existing mortgage. That's the whole focus of this, and we're going to be able to turn these loans. Once the loan is submitted, we want an underwriter to look at it, check the boxes, yep, this is done, this is done, this is done, and push it to documents.
All right, so lots of changes on the case numbers. So you always need to have the prior FHA case number information in order to order your new case number. Branches, you're going to order through FHA Connection just like you do on any other loans. No process change there. Brokers, you're going to continue to order through, you know, case number at mortgageworksamc.com. Borrowers' names in FHA Connection must reflect exactly as the names will be reflected on title vesting. And you've got to have 3 things on the date of the FHA case number assignment. Number 1, the mortgagor must have made at least 6 payments on any FHA insured mortgage that is being refinanced. And at least 6 full months must have passed since the first payment due date on the refinance mortgage, and at least 210 days must have passed from the closing recording date of the mortgage being refinanced. So I just want to make you aware that's a very important guideline, because if you don't meet one of those, you're not going to be able to get a case number, or we're not going to be able to do the loan until it has met all 3 of those items.
And we've found several times where somebody didn't realize that, and they're pushing and pushing and pushing, trying to get a case number. And what they've done is sometimes they've gone around the system and been able to pull one, because what they did is they changed it from a Streamline Refinance. Unfortunately, that invalidates it as being a Streamline going forward. So just make sure that you've met these items in the bottom, and then you'll be able to get the case number. If you can't, it's usually because one of these things has not happened. The time commitment has not passed.
Correct. In addition to that, as you all know, the main reason why we've seen such an influx of Streamlines is that HUD reduced the annual MIP on all loans greater than 15 years by 0.5% effective with case numbers ordered on or after January 26th. So we've all been through now that time period, and we've published several bulletins to assist with these changes, and I've given those here to you for not only retail but also wholesale. It's basically retail 5, 6, 7, 9, 10, and 12, and wholesale 7, 8, 9, and 11. So, and just so you know, anytime we make changes or put changes out in a bulletin, all of that information is automatically updated in our underwriting guidelines. So everything's in sync.
So the existing case numbers, again, remember, if you had an existing case number and you wanted the borrower to take advantage of the lower MIP, it had to be canceled, and we had to have proof of cancellation that HUD had canceled it before we ordered the new one. We've had a few times where that seems to have slipped through the cracks. If you have FHA loans in process today and that case number was pulled prior to January 26th, I would recommend that you make those cancellations, because after February 25th, they can't be canceled out. So you're going to have to go through the normal life process of those, which could drag out literally another 60, 75 days after February 25th before you can get a new case number. And, of course, case numbers have to be canceled through the AMC. New case numbers that did not have a prior case number can be ordered after the 26th to take advantage of the new MIP. And just remember that HUD had given us a window of opportunity to be able to order appraisals and those type of things without a case number. That window has been closed. So if you have an FHA transaction besides the Streamlines that need an appraisal, even if you're doing one with an appraisal, you need to make sure now you have the case number in advance.
That's correct. All right. So this is just a screen of what a refinance authorization results looks like out of FHA Connection. And one of the things that you always need to be looking at is the original endorsement date. And you're probably wondering, why do I need to look at that original endorsement date? We'll show you in a moment. Let's move on to the next
Let's
screen.
keep it suspenseful.
So on the second screen, as you can see, there you go. As you can see in the red circle, there's an annual MIP factor, and then, of course, your lender ID number will also populate. There's a lot of good information that's needed on the refinance authorization results in order for you to calculate your loan amount. So let's go to the next screen, and I'll show you what we've got down here. So, okay. So whoops, what happened there?
Back one.
So let's leave it right there. So as you can see, there's a list of all kinds of things on the left-hand side of the refinance authorization results, including your upfront MIP earned by HUD and your unearned upfront MIP, the original property value, and your unpaid balance. So 4H, as you can see there, in this example shows 0. So in this instance, this particular borrower would not have an MIP refund credit. But if you've originated a loan, typically in the last 7 years, you're going to have a little bit of credit typically. So let's go on to the next. And then 4I, which is another important value, is the value that the house originally appraised for. And that's important in determining the monthly MI without an appraisal, because we have to make a determination what the final LTV will be with the new loan amount. And with that final LTV, that's how we determine our monthly mortgage insurance factor.
And that factor will vary by 5 basis points depending on what the final loan to value is. And that's why it's important sometimes that, you know, by financing additional amounts into the loan, sometimes you're going to push that borrower into having to pay 5 basis points more on their MI going forward forever. So just be cognizant of that, whether it's high balance and it's 100 to 105 or regular 80 to 85, that, again, that could work out to quite a few dollars for the borrower.
Exactly. Let's go to the next. So calculating the loan amount. The mortgage being refinanced must be current. So if we're in February, it's February 2nd, a refinance on any mortgage in this time of the month, they have had to have made their January payment already. They have to be current. Like I said earlier, we're going to allow to include up to 60 days interest only and up to the 2 months MMI. The borrower cannot finance in delinquent interest, late charges, or escrow shortages. All of that must be paid out of pocket. So I want to touch back on something that Gary just said. In working on this for the last couple of weeks and working with several examples, what we found was if we only finance 30 days of interest on some transactions, although the borrower had to come in with money today, we were increasing their monthly factor from 0.80 to 0.85, which over the life of the loan turned out to be a lot more money than what the borrower was having to come in with today. So we want to encourage you to look at the overall impact of the money that they're either coming in with today as compared to what that monthly factor is.
Yeah, and I want to make another point, well, actually a couple points. You know, these loans, depending on when you take them, you know, again, if you get all your documentation, you submit it correctly the first time, it should go through pretty quickly. If you don't, you know, and for whatever reason it gets snagged up in the system because it did not have a demand, or we didn't know who the insurance was, or there was subordination or something else that should have been looked at ahead of time, you know, that's going to slow down the progress of this loan and obviously some others that would be behind it. Just want to make sure, if you're talking to a borrower and you're taking a loan app at the beginning of the month, you know, and they say, do I have to make any payments? My recommendation is always, as an originator, keep your payments current until we close. Because the last thing that happens, if for some reason you think it's going to close at the end of this month and it doesn't, and that borrower does not make their payment, they now have a 30-day late and they're not eligible to Streamline Refinance. So don't put yourself in that position where you have given them the ability to not be able to streamline. In fact, we're going to try and close most of our streamlines a couple days before the end of the month, so that for whatever reason, if there's a hiccup or something, you know, something shows up on title or something else that we hadn't anticipated, your borrower still has the ability to make that month's payment so they don't become delinquent. And one other thing is, you're locking these loans, make sure you get a lock time frame that is long enough to extend out. Nothing's worse than to put, you know, Streamline Refinances in process and then find out you didn't have enough lock, or the market at some point will turn and you don't want to have to go back to the borrower and say your lock's expired or something of that nature. So make sure you make your locks appropriate for the time frame.
All right, let's keep moving. So it's basically a simple calculation. Your current principal balance plus 30 or 60 days of interest plus up to 2 months of monthly mortgage insurance minus your MIP refund credit for that month's closing, and then that equals your max base loan amount. And now, that doesn't mean that that's how much of a loan you have to do. You can actually have a loan amount that is lower.
So I could have a borrower come in with $20,000?
If they wanted to.
Wow.
But then you'd want to look at whether they were at 80% or less.
Doing a streamline or not.
Yeah, exactly.
Okay.
All right, so let's keep moving. So out there right now, we've got in Mountain West Financial, FHA Streamline Refinance, and there's a lot of auto calc on this form, and it's constantly changing in these last few days, so we're trying to make it as efficient as we possibly can. It allows you to input the date prepared, the person who's preparing it, the outstanding principal balance, the next payment due, and obviously we know that if the borrower is next due for 2/1, that they've made their January payment. Obviously, their interest rate, 4.875 in this example, and then it gives you the option to put in 30 days or 60 days. And it calculates that interest for you automatically, which is nice, so you don't have to manually do that. Now, be aware that on non-owner occupied properties, which we can do on an FHA Streamline, you cannot add in 30 or 60 days of interest.
In fact, you can't add in anything.
That's correct. So one of the changes that we made on this program for you was the fact that we're going to allow the MMI to be from the existing loan, but no more than 2 months can be added in here. And in this example, we've added in 2 months of MMI, which came off of demand. The next line is your MIP refund credit, if applicable, and this is the closing month. And again, back to your refinance authorization results. On there, it typically gives you either, it gives you 2 months always. So you have the option of picking one or the other month depending on the month that you're closing. So if it's February, you're going to put closing month February, you're going to pull the MIP refund credit from February. If it's closing in March, you're going to pull the one from March. So make sure you pull the correct one. Obviously, you've got an underwriter coming behind you. She's going to double check that as well. And then it calculates your maximum mortgage before the upfront MIP, in this case, $318,349.60, and the max base loan amount that we can do is without the cents.
You know, so it sounds like you guys have made this simple enough with this form that really an underwriter should just be looking over the work. They're not going to redo any calculations or anything as long as the worksheet's filled out.
As long as the worksheet's right, they shouldn't have to do that, although many of them do, just because they want it their work. So the next part of I couldn't get the worksheet on one page, so this is the next step. So based on the prior loan amount of $318,349, we've got upfront MIP based on the chart, which is on the next screen, 1.75. Their new upfront MIP is going to be $5,571.11 for a new total loan amount of $323,920. Now, our original loan amount recorded is $323,924.
So here's one of the things you want to pay attention to, and Shelley had alluded the date of endorsement, right?
Correct.
Earlier.
Yeah.
So because of that, you might have you might be talking to somebody that took out an FHA loan back in 2010 or 11 or 12, or, and again, there's a lot of different MIPs that have been out there during that period, which would equate to what potential savings, or taking somebody's MIP and turning it into a lifelong MIP as opposed to one that might be ready to fall off of the loan today.
Correct.
So this just gives you a little cheat sheet as what those MIs were and what dates.
Right. And so if you look at the right-hand side of this chart, we actually still have some loans out there that are being refinanced that were endorsed before 5/31/2009. And if you have one on your refinance authorization that was done and endorsed before that date, their upfront MIP is only 0.01% and their monthly is only 0.55%. So we want to make sure that the borrower gets the best MIP. But other than that, you need to look at this chart to determine what your LTV is first. And then based on that LTV, you're going to be able to see what your premium is going to be, either 0.85 or 0.80, 0.70, actually not 0.70, but 0.85 or 0.80. So the monthly MI is based on LTV using the appraised value that's reflected on the MIP authorization and the term of the loan. So let's go on to the next screen. So in this case, our new base loan amount was $318,349. Our original appraised value was $329,900. So our loan to value is 96%. And anything over 95%, you're going to have to roll it up to the next level, which is 0.85%. But in the event, that it was below 95%, you'd be at the 0.80. So that's one of the things you need to look at. The max term on this is always limited to the lesser of the remaining term of the existing mortgage. In this case, it was 29 years plus 12, 41, and we don't do a 41-year loan, or 30 years. So in this instance, we're going to do a max term of 30 years. And we've used the correct MI factor of 1.75 based on the chart, and the correct monthly annual premium of 0.85. Go ahead. On the second page of the loan amount calculation, we've got short funds to close on an existing loan. And in this example, we've got some of the things that you automatically will put in, which is $317,776.75, which is your principal balance on the existing loan. The interest on the old loan off the demand. So this may be a little bit different than what's actually calculated for whatever reason. I haven't seen one that's exactly right on. And then your monthly MIP off the demand. Now, in some examples, you're going to see where demand may have 2 or 3 months worth of MIP on there. We're going to only finance up to 2. So in the event that there's 3 months on there, then you're going to have, the borrower would have to come in with that. In this instance, our subtotal is $321,409.20. Our new base loan amount was $318,349. Our MIP refund was $2674.16. So the borrower was short funds to close the existing loan of $386. So that's what the borrower would end up having to come in with, plus any additional other fees that weren't financed into the loan. And those fees would have to be verified in a bank account through the loan application.
just like we would having to verify fees or funds to close on any other FHA loan. We would use basically the same documentation type test.
Exactly. Move on.
So just back to that briefly. So if you're looking at a demand from your borrower's loan, which you should absolutely look at it, everyone, and there's delinquent things on that, like delinquent late fees and stuff, those are going to have to be paid in cash by the borrower. We can't finance them, and we're not allowed to use them as credit. So we want to make sure that, you know, if the borrower is delinquent, that they have to pay that out of pocket.
That's correct. So let's talk about net tangible benefit. And Gary talked about benefits of the borrower and doing what's right for the borrower. There is a minimum criteria for net tangible benefit, and it's defined as a 5% reduction to the principal and interest of the mortgage payment plus the annual MIP, or refinancing from an adjustable rate mortgage or an ARM to a fixed rate mortgage. So in our example, the total mortgage payment on the existing FHA insured mortgage is $895, and the total mortgage payment for the new FHA mortgage must be $850 or less. We are seeing some significant changes or savings to the borrower on a monthly basis with this program and the reduction to 0.80 or 0.85. So this is a great program. And just so you're aware, reducing the term of the mortgage in and of itself is not a net tangible benefit. HUD made a lot of these changes, as Gary alluded to earlier, in HUD Mortgagee Letter 2011-11. So if you're interested and you want to really get into the minutiae, you can go back to that mortgagee letter. We also have a net tangible benefit worksheet, excuse me, that's on the internet or intranet, and it is a pre-fillable document. In this case, this showed that the borrower had a current P&I payment on the first mortgage of $1,714 and monthly mortgage insurance of $350 for a total outgo of housing of $2,064. The new proposed P&I in this instance dropped to $1,546.44 because not only did we drop the interest rate from 4.875 to 4%, but we also reduced the monthly mortgage insurance from 1.35 to 0.85%, dropping it from $350 to $222.60. So that significantly dropped this payment to $1,769.04 for a difference of 14.29%, or a benefit of more than 5% reduction.
And had we have dropped it so that the loan to value based off the original loan amount was below 95%, we could have actually dropped the MI a little bit more and given them even a higher tangible benefit.
Absolutely. And so when looking at doing a worksheet, I mean, you could have that conversation with the borrower if they'd be willing to come in with some additional money and not finance 60 days in or the 2 months of MMI. You might be able to get them under so that they qualify for the 0.80 and save them just a little bit more money.
And you'll find a lot of that has to do with how long the loan's been on the books, because sometimes it'll do it automatically, and other times a couple $100 investment may make the difference. So just be aware of that.
Okay. So the second page of the net tangible benefit worksheet is the list of the items that we can do to benefit various types. So going from going to a fixed rate from a 1-year ARM, or going from a 1-year ARM from a 1-year ARM. There's just certain products that we do here at Mountain West.
And I'm going to tell you, in today's low interest rate environment, I don't anticipate we're going to see anything with a fixed rate going to an ARM. I don't believe that that would necessarily be a great tool to give to a borrower. Maybe someday it might be, but the spread between the FHA adjustables and the FHA fixed is so small that you might not be able to even get that to fit into a net tangible benefit and or the interest rate reduction requirement. So most of what we're seeing today is fixed to fixed.
I would agree. So there's some additional rules that apply to all Streamlines. It must involve no cash back to the borrower except minor adjustments at closing, and may never result in an excess of $500 cash back. Otherwise, it must be a principal reduction to the new loan. So just be aware of that, and funders are looking for that as well as the underwriters. LDP GSA, just like on any other FHA, must be checked on all parties. So in the event that you have any questions, it's basically going to be your borrower and or borrowers and the loan officer who would have to be checked, because obviously we don't have a seller or a real estate agent. Thank you. This is kind of important, and something that you may or may not look at is provide a copy of the current hazard insurance policy reflecting that it's owner-occupied. Now, sometimes people move out of their homes that have FHA financing in, and they become rentals, and we'll get a hazard insurance policy in here reflecting that it's non-owner. And if it says non-owner, we're going to end up doing that loan as a non-owner. When you calculate the non-owner occupied loan amount, it's going to be lesser because we cannot finance in the interest nor the MMI.
And I think most cases it's really difficult to do an FHA streamline on a non-owner occupied refinance just because of some of the constraints. The borrower almost always has to come in with money.
I would agree with that. Okay, keep going. All right, in addition, loan amounts may never exceed the statutory limits for the county except by the amount of the new financed MIP, or if the original loan insured is in a county where statutory limits have decreased. In San Bernardino County and Riverside County being a prime example, our loan limits decreased, so therefore we've got a lot of loans out there that we did above the 355 threshold that people would like to do streamlines, and yes, we can do that. And again, we want to reiterate that you can never include accrued late charges, escrow shortages, subordinate lien repairs, or delinquent interest in this loan amount.
So assets to close. In almost all cases, as we've been watching the loan calculations come through in the locks, in almost all cases, between what you can include in the loan amount and what's available in what we call premium or rebate pricing, it covers almost in all cases most of the money. But in the case where you have escrow shortages or something else that is going to require cash, or the borrower truly wants to go down and pick up that other 5 basis points in monthly savings on the MI, there may be a couple $100. I would make sure that as I'm talking to my borrower, say, there might be options that may give you a better loan. So I would always have them give you those bank statements just in case, if you want that option, because what you don't want to do is be scurrying around at the last minute. If you have them, you have them. If you don't need them, you don't need them. But again, it follows through with the normal FHA verification of assets. So if we need monies to close and there's large deposits on that bank statement and you're going to need that bank statement, then please make sure that when you submit the loan, it has the backup documentation or letters of explanation or whatever else is needed for it, so you don't slow down your loan and your borrower's loan during the process.
Good point. So as we indicated, there's forms out there for the Streamline. They can be found on the intranet. Again, we gave you a link in bulletin on Thursday and or Friday, and also on the internet at www.mwfinc.com. And what we've got out there is the FHA Streamline Checklist, the Net Tangible Benefit Worksheet, and the Streamline Refinance. And I'm just going to caution you, you need to use whatever's on the internet. If you save it, remember, we're constantly updating and changing things. So to make things easier to use, we want to make sure that any changes that we've made that you're aware of. So it's always safer to use the forms right off the intranet or the internet. Make sure your loan's compliant.
We're really excited. This is there's an opportunity out here that we haven't had as an industry for quite a while, and that automatically dropping that MIP in most cases, as long as interest rates are the same or lower, which they are in most cases today, lots of opportunities for these streamlined refinances. And we want to make sure they're easy to package. There's very little documentation, but the documentation that are required has to be in those loans for us to do them. Make sure if you're taking them that you have a lock that is appropriate for the time frame in which you need to close that loan. And just know as time goes on, over the next several months, it's possible that most lenders, including Mount West, may start to get backed up a little bit on these loans and just be cognizant of turn times and whatnot as we go through the next several months.
All right. So we want to both say thank you for attending today's presentation. We're going to open up the webinar for questions. So it looks like
so we're going to answer a couple questions have showed up, and I know most of the statements have to do with having some issues getting on. The QM report is not required on these loans. There is a basic LDP GSA that's required on the participants, and I think that's as far as other ancillary type stuff, that's all that's required. Want to complete 1003, including income. So there's a comment out there talking about that CalHFA does want a complete 1003, and I think the point we need to make sure is if there's something that's going, if one of the subordinate financing has additional requirements up above what we require in our packages, that's fine. If there is income on there, we are not, unless there's something that's dramatically detrimental to the file, that's not going to be a challenge for us. We pulled the FICO score, now this is for somebody that's inside the Mountain West system. The FICO score would be available in WebTrack, and we'll go through and maybe make an internal statement to that. What if one of the borrowers is no longer working on a, but main borrower is?
So the question is, what if one of the borrowers is no longer working on a Streamline, but the main borrower is? So remember, we've got an abbreviated application, and we're not doing a verification of employment.
Correct.
So we would not know that.
I want to make a point that I think a lot of people don't realize. For years, FHA Streamlines were looked at, and they had a higher delinquency rate. When HUD made those changes on Bulletin Mortgagee Letter 1111, they stated right out, because they're not allowing an increase in the loan amounts, that they felt that requiring employment and other things was not necessary because the borrower's been making their payments, there's zero delinquencies up to now, and now we're going to lower their payment. In some cases, we've seen payments lower as much as $400 a month on some Streamlines that have come through. And, so we're not worried about the employment of one borrower to the other. Again, there may be issues with that secondary finance. In this case, it might be CalHFA. You might want to check with them and see how they're looking at it, because they may require some additional underwriting that we're not.
All right, and in addition to that, FHA realizes that in the recession that we've been in, there have been people that maybe are two-income family, and one of them may be unemployed. But again, we're putting these people in a better position. If they've been making that payment all along, and we're lowering their payment $400 a month, whether one is unemployed, we're putting them in a better position.
One of the other things, and on FHA's, from FHA standpoint, the neighborhood watch numbers, including Streamline refinances, are actually better than those without the Streamline product in it.
Interesting. The next question is, if the funds to close are less than the mortgage payment amount, do we still need to track all the funds to close?
And the answer to that would be yes. If some of you have looked forward into the 4000-1 that's coming out in June of 2015, they state that if it's less than that. But until HUD gives us guidance otherwise, the existing guidance says all funds to close must be verified today.
Perfect. We wanted to bring up something that was in one of our memos, bulletins, 15R-021, discussing yield spread premium or lender credit. So we just want to make sure that you are aware that yield spread premium and or lender credit cannot be applied toward the principal, interest or monthly MIP on the existing loan, and that, however, it can be used, applied towards miscellaneous fees like the demand fee or demand statement, reconveyance fees, any kind of thing like that, and prepays on the new loan if need be.
Next question, I took a preliminary application on FHA Streamline. The guy has a TIN rather than a social. I did some checking, and about half of the lenders I saw online will allow Streamline with a TIN, and the other half won't. I could not find any guidance in our guidelines. Will we allow this type of SL?
You know, that's a great question, and we're going to have to get back on that. I would hesitate to say yes or no at this point, and thanks for the question. We'll have that verified and sent out to you.
Great. And the next question is,
can we add 60 days interest even if the refi will close within 30?
Okay. Again, remember, you've got to look at your demand. If the demand only has 30 days of interest, you're only going to finance 30 days of interest in the loan amount.
Next question is, I read somewhere that the loan amount cannot be moved, or excuse me, more than the original loan amount. If this is, we have to reduce it back to the original loan amount. Is this correct?
Yes, that is correct. The new loan amount cannot exceed the original loan calculation. And when you go in and look at your worksheet that we've created for you, underneath the new total loan amount, there's actually a place where you're going to input the original loan amount recorded. Now, we've actually put a stop in there. We've actually put a stop in there so that for the underwriters to indicate that it's going to be an error. And we also have a calculation that we're going to add to the worksheet to show you how to properly back into the correct loan amount and the correct upfront MIP, so your new loan amount does not exceed the original.
Okay, and the next question is the location of the net tangible benefit worksheet. That's on our intranet, and we showed that little address, and we'll show that again.
And it's also on the internet as well.
And next statement is, Gary, please talk about our competitive advantage over the other lenders doing Streamlines. That still requires them to credit income qualify. I'm guessing that not many of us are doing true Streamlines.
Well, and again, that has to do with the secondary market. There are still a couple large aggregators that want to see some basic qualifying done on loans, especially if they were loans that were not initially originated by that lender. But again, we currently are not requiring that. We are not looking at the income per HUD guidelines, and we're not looking at the credit per HUD guidelines. But we are very interested in what that mortgage payment's been. And again, you have a little flexibility with what FICO score you're using. Just make sure once that FICO score is provided to our underwriting, that is provided to underwriting, that's the credit score we're going to use to complete that transaction.
So there's a comment up here to remind loan officers to also ask in the application process if the borrower has received HERO financing. And for those of you here in the Inland Empire, HERO financing has been, there's a lot of it. And unfortunately at this time, those groups that hold the mortgage for the HERO financing are not willing to subordinate. So in those instances, you would not be able to do a Streamline Refinance.
And in fact, unless, yeah, I don't want to get sidetracked, but just that's a great question. And again, that gets back to the, I know that I talked about secondary financing, but if somebody's used the HERO program, unfortunately, that is looked at, even though it's collected with the taxes, it's looked at as secondary financing.
Correct. Next question is, are we going to speak about the escrow transfer of impounds from old loan to new? Where do I find the amount of the credit on the old loan? Okay. So we're talking MWF to MWF. We sent a bulletin out, and I can't remember which one it is off the top of my head, about transfers, escrow transfers, and it should walk you through that. And if you have any questions, I will get with you on it. And I've got copies of all these questions, so I'll be able to circle back around to you.
But there was one of our bulletins that we publicized. We probably should have put what that name was, but it discusses if Mount West is currently servicing the loan, how to go about moving those funds from one loan to the other.
Okay, the next question is, what do we do in the event that the borrower has made their February payment and we ordered a new demand and it states next payment due is March? However, there's still 3 months of MIP instead of 2 being collected.
This is interesting because this was an actual transaction that we went back to Senlar in because it didn't make sense why there would be 3 months of MMI listed on the demand, and we actually got the corrected demand for the branch on that. So look at your demands very carefully. They may or may not be correct.
Okay, the next question is,
let me just follow up on that just one little bit more. If for some reason there is another month of MI due, then we want to make sure that has to be paid in cash because it can't be financed and stuff.
Next question is, can a portion of the upfront MIP be paid in cash, or is it all or none?
It's all or none. That's a good question.
Yeah, that hasn't changed at all. The next question is, if we have a Streamline set to close in early March, do they need to make their March payment?
If it's set to close in early March, so there's one other thing that we didn't really discuss through. There's on an existing FHA loan, and all these loans that we're going to be doing Streamlines on now were done prior to January 26th. The investment community today still gets interest to the end, it's called the next installment due date, which means all FHA loans will be collecting interest to the end of the month and whatever month it's paid off. So typically, again, depending on how much credit you have available, you want to make sure that the interest that is due, if a loan is going to be paid off at the beginning of the month, that borrower in many cases is going to be paying, or somebody will be paying double interest on that loan because interest will be collected on the old loan basically to the end of the month, and interest will start on the new loan based off the day of funding. So, I would anticipate anytime you're talking to the borrower that they're going to pay 5 days of double interest because we're going to try and close a lot of these loans around the 25th of the month just to make sure we don't put them in a bad position of having a late payment, which would stop them from being able to be FHA, have that be eligible for a Streamline down the road. But just make sure if I would coach them, I'm taking a loan app today, the odds of me closing a loan in January 0, in February, if I'm taking an application today, if I have everything on my desk and I could submit the loan in a day or two, it's fine. But after you're submitting a loan, after about the 15th of the month, it probably won't close till March. And then I would make sure that the February payment's made.
Okay.
Next question is, if they have MI that was supposed to drop off and we refinance them into another FHA Streamline, the new MI will remain until the FHA is paid off. That's true.
Yeah, I believe that's true.
Okay.
All right. So some of these questions are duplicate of prior ones, so I'm going to just kind of sort through here. One of the questions is on non-MWF and MWF loans do not require any employment info as long as no CHDAP. And that's correct. This is an abbreviated application, whether it's MWF to MWF or non-MWF to MWF. Next question, if a full tri-merge credit report is provided, how are we to treat major derogatory events like BK foreclosures, short sales?
Well, that's a very good question. First of all, we in the underwriting department would prefer not to have to struggle with that, so please don't provide them. But in the case that we get them in, we are going to ignore them unless it's something that is dramatic. Now remember, anything that affects title could get in the way here. So if you've got liens, those type of things that could take precedence over our new loan, that will be a challenge. And that should be dealt with as you're looking at your preliminary title report and whatnot. But, it's to everybody's benefit. Just give us 12 months rating and FICO scores. That's what we're looking for. If you give us other stuff, the underwriters have been told to, underwrite around that. But, it's really difficult for them. Just, conceptually to ignore bankruptcies and foreclosures and everything, but that's our current instructions.
Okay, next question. Is there a different loan amount calc when new loan exceeds original? Yes, there is. That's a great question. And actually, we're updating the worksheet again today because we had underwriters underwriting over the weekend that came into this, and so we're going to make that part of our calculation as well. So we will get back to all of you on doing that. And what we're finding, just so you know, the feedback that I got from the underwriters this morning was that typically it's the loans that have been done with the last couple of years that when you add in those 60 days of interest in that 2 months of MMI, that's when they're exceeding the original loan amount. So just so you're aware, in any event, all of those loans, anytime they do exceed the original loan amount, they're going to have to come in with funds.
Next question is there a way to pull servicing loan numbers through DataTrack?
Delaram, I'm not sure the answer to that question.
I'm sorry, what was that question?
It was, is there a way to pull servicing loan numbers through DataTrack?
It's in there. Is it in there? Okay, the next question on MWF to MWF Streamline. If the borrower feels his scores have increased, so we pull credit, but indeed it actually went down. Are we stuck using the lowered score or revert back to using the one in the original loan package?
So whatever underwriting sees is the score that we will be using.
Good answer.
Next question is, what is the LTV breakpoint to reduce the MIP from 0.85 to 0.80, and how much do we document the current LTV?
Well, the way you document, first of all, you're looking at the appraised value in the FHA connection for making your calculation, and the difference is 95 versus less than 95. Is
correct.
That correct?
That's correct. And again, you need to refer back to the upfront MIP chart that shows what the monthly MI is going to be, what the upfront MI is, that actually breaks it out for you, what the break point is.
And again, you're going to get that initial one off of your out of your case query out of the FHA connections. And we're running out of time here, so we're going to just answer one or two more, and then we will put an FAQ together for anything else that we find in here that we think will be good information, and we'll post that on our website.
Yeah, there's a lot of duplicate questions as we're going through, so we're trying to scan through as quickly as we can. All right, it looks like again, okay, again we're seeing duplicates. So I think at this point, what we'll do is we'll just finish up going through these. We'll create an FAQ with all of your questions. And then hopefully we can get them all answered, and we can close lots of Streamlines in the month of February.
March and April and May and June. Hey, one other thing that one of these questions kind of brought to mind, just be careful. I know that some of you guys are reading forward a lot of information, which is great because we as an industry have to stay informed. That 4,000 underwriting manual that comes into effect on June 15th is for case numbers as of June 15th and further. So we will be putting out some additional guidance probably about the 1st of May, which is going to change some of our streamlined underwriting guidelines so that it says after a case number pulled on this date, these new things go into effect or these things no longer are in effect. So, but until then, you're working off the 4155 in conjunction with Mortgagee Letter 1111. And we really appreciate you guys taking the time to join us today. If you have any other questions, please contact Shelley Collins. And what we'll do is we'll continue to build some constructive FAQs on our website. So any other unique questions that come up, we'll continue to add to that as we go along over the next several months.
All right. Thanks again for everyone attending, and have a great day.